here. Back here with another video. So guys, on this video here today, we are going to be talking about a guide into making a trading plan. So this is some sort of guidelines on how you can make your own trading plans. So I formulated like a few steps that a person would follow before they enter a particular position or trade, and another steps that they could follow after they had exited that particular trade a position. So let's jump on it now. So guys, know that these videos are mainly for what educational purposes now. So our risk disclaimer here always highlights that trading CFDs and leverage products involves a high level of risk now. So a person or a trader, an investor, is liable to either a portion of their investment or the entire loss of their margin deposit. So do not trade money you cannot afford to lose. So these videos are mainly for educational purposes, not investment advice or trading advice. So guys, today, as I said, that I formulated some 6 steps that a person should follow before opening a particular trade, right? And I formulated another 4 steps that a person might do or should do after closing that particular trade. So the first ones are 6 before you do, and then 4 after you have closed that particular trade. So let us jump on the 6 steps now. So step number 1, you should always analyze your charts. Analyze your charts. Before opening any trading position, make sure that you analyze the charts. You should identify market trends, whether the trend is going up or the trend is going down or it's consolidating, and also be able to spot major key levels. When I'm saying major key levels, you should be able to spot major support levels and resistance levels. You should be able to mark out FTR candles. You should be able to mark out swing high points, and should be able to mark out swing low points there, right? So that was step number 1. Step number 2, you should always identify safe trading areas now, and let price reach those areas. So what am I saying about this now? Number 1, by identifying safe trading areas, you should be able to mark your supply and demand levels there. Some people, they can say support and resistance, but let us use supply and demand level at this point. And then highlight all previous FCRs, as I said, and all other block and order flow levels, and also draw all relevant trend lines. And do these steps in all higher time frames. When I'm saying higher time frames, it can be on the weekly, the daily, or the 4-hour charts. Why? Because you are looking at the bigger picture of the markets. You're looking at it at a broader picture, because the smart money, the institutional guys, they look at the market from a broader perspective rather than in the smallest time frames. So you should always look at the bigger picture, which is the weekly, the daily, and the H4 charts. So that was step number 2. Then the third one, once your zone has been reached, either a supply or demand level or resistance, or the market has touched a particular trend line because you drew it, you should look for a confirmation. You can either look for a reversal candlestick, right? A bullish engulfing, or a bearish engulfing, or it can be a pin bar, a hammer. You can also look at chart patterns. It can be a chart pattern, or it can be some fundamental news, because sometimes news, they also trigger most trades. It's either a trade is going to break out or it's going to reverse, when some fundamental news are going to come out at the particular point or at the particular day. So you should always look for confirmation, even though you should always check even the economic calendar as well to look for confirmation that, okay, maybe this move will be accelerated by this particular news or something there. Then after you've looked for your trigger, you should always try to backtest that information before you place it on a real trade. And make sure that the thing it is backtested before you place it on an actual trade. So after the confirmation part, getting your confirmation, you should have a precise entry strategy. A precise entry strategy. So some people like to get in aggressively. Some people just want to get in like in the market execution. They want to get in now. They don't care whether it's volatile or not. They just want to jump in and get in now. So some people want to wait. Maybe the market will break out the particular level and then come back to retest that level, and then they place their pending order and then they run with it. Some people like to wait for the market to actually come to the particular level and retest that level, and then it falls down. So it depends on your risk appetite. And then number 5, you should always set your stop loss. Your stop loss, it protects your account, it protects you from losses, it protects you from emotional instability. So you should always put your stop loss. So your stop loss defines the point where you become wrong in a prediction. Be extremely careful on that step and give the market some space to breathe and for fluctuation. So it's important that when you put in a stop loss, you should always give the market some space to breathe for fluctuation. Maybe it is a false break. You should always give the market to breathe, to fluctuate before it goes maybe in your direction. If your stop loss gets hit, you got hit, it's fine. You move on to the next trade. So after you've made a stop loss, you should always set your target, because you've protected your trade, but now you've entered and protected your trade, but now you need to set where you are going. Where do you want to get out on this trade? Where do you want to start protecting your account? When do you want to start protecting even your profits as well? Know exactly the target levels, know the points where you start protecting your position, where you start taking profits. Be very strict and don't let your greed and fear intervene. I like this point. This is very powerful and strong. Do not let your greed and fear intervene. Only then trade a position is open. So the greed and fear part, I always try to tell people that it's better to be fearful than to be greedy. Because when you are fearful, let's say the trade is already in profits about 10 or 25 pips, you rather close the trade or move your stop to break even to protect your account. So when things go against you, you already made some money on the trade. But then being greedy, in order the trade is already in profit 20 pips, and then you try to double down on the trade. When you try to double down, that's where you are becoming greedy. And then when things go against you, you lose the money that you already made. You also lose the money that is already on your account. You see, so greed, it never works. It can work 1 in out of 10, but most of the time, greed, it works against us, guys. So let us try to work on our greed levels. I know some people say greed is good. Well, if it's good for you, it's okay and good luck. But I always try to tell people that it's better to be fearful than to try to be a hero and be greedy and try to fight the market. So after you've done all those 6 steps, no matter what would be the end result of a trade, you should always assess it, monitor it, and figure out the mistakes that you have made. You've done your entries, you've done your stop loss, you've analyzed your charts, you've set up your targets, you've highlighted your FCRs, and then you've entered the position, and then now you close the position. Then what happens after you close the position? Now let us talk about the 4 steps that you should do now after the position is closed. It doesn't mean that, okay, I've made some money in the trade, let me close it down like that and move forward. You should always try to assess the things that you saw in the trade. Number 1, you should always keep a journal. This is the most important part here. You should always keep a journal. This is my journal. This one, I have it with me every day. I write everything here on this one. I write almost everything here on this one. I write ideas. I scratch out everything. I even write chart patterns. I write the stocks that I saw maybe the previous day. I write the stocks that I think they will do good. This is where I draw almost everything. This is my mind map. And then this one here, it's new. This one here is new. This is where I record this one is where I record my winners and losers. This one is new. I started this one at the beginning of this month. January 2020, and I think I'm going to be holding it for the rest of the year. You can see this one is new. I've only written a couple of things on this one. It's new. And this one here, I've had it for years. I've written down every stock I've ever bought. I've written down every share I've ever bought. I've written down whether it was a winner or it was a loser. I've had this one for years. You can see how crusty it is because it's been around for a while. So I'm still gonna keep it because sometimes I go back and look back in time and say, wow, I once did great on a particular trade. So if when I'm feeling down, I go back and look at this one. It gives me some motivation that once in a point in my life, I was once a winner. So I need to bring back that winner inside of me. So number 2, you should keep notes. As I think I just explained number 1 and number 2 in the same time. Because if you're keeping a journal, you should always keep some notes. So note any particular thing about a certain trade. If you see something unusual about the trade, you jot the thing down, write it down, you even take down a screenshot of it and save it down somewhere. And also, if it's either an unusual pullback that you saw, it can, or maybe a pullback that surpassed that level, you jot it down, or a trade that was lost due to a news, or that was lost due to news, or it was accelerated to news. You write it down so that next time when you see a news event like that, you do not trade because that news event, it's really, really bad for your strategy. So you should know those things. So number 3, let us jump to number 3. Record all your gainers and losers in percentage value or in monetary value. It's up to you. You can record it in percentage value or in monetary value. It's really up to you. And then if you are recording your gainers and winners, it should help you to set up better targets the next time. And also it will help you to reduce expectations. It will also help you control your risk tolerance. Do not overtrade. It will also help you to control your emotions as well. So the third point here, again, it is very important. Controlling your risk tolerance and controlling your emotions and reducing expectations when it comes to trading. A lot of people come to trading with high expectations, and when things do not go their way, they start saying bad things about trading, and they start saying things about people, they start saying things about the markets, they start blaming the broker, they start blaming other people in order before but they do not take responsibility on their side that they did not reduce their expectations, they did not control their lot sizes, they did not control their risk tolerance, and then they did not control their emotions as well. So trading, guys, it is very, very important that you trade when your emotions are in a better standing or in a better position. So point number 4, you need to identify whether any mistake was made. If so, you made a mistake, you should take accountability of that. Do not blame people, do not blame your mentor, do not blame the broker, do not blame it on other people, because the person who executed the trade, it was you. You were the one who pressed the buy or the sell button. It was you. You should learn from a mistake and learn from it and try to do better next time. So guys, I hope these steps will be educational to you guys, and these are just minimum requirements for a person in building up a trading plan, but yet they are very, very powerful, and as you mature as a trader, as you mature in your trading, in the trading assessment plan will be more sophisticated than this one. So this is just a guideline or a guidance, as I said earlier on, that these are some of the steps that a person could try to follow before they enter a trade, and then monitor their trade, and then they should follow these other steps, the 4 other steps, after they had placed their position. Jot everything down. Something is literally unusual, write all those things down, keep a journal, write some notes, make some screenshots, take accountability of your mistakes, and then do not underestimate the importance of this trading plan. Treat it as the main element of your trading routine. So I hope, guys, this will be very, very much educational. I thank you guys. I will definitely try to see you on the next video. So remember, this is not investment advice, but educational content, because we try to educate people and give the message out there about investing and trading. So guys, do not trade money you cannot afford to lose. So I thank you. I will definitely see you in the next video. You can contact me there on TradingView, and check out our page on Facebook, and follow me on Twitter, Stocks for Hope, and my personal handle, it's Bo_Lamini. And then if you wanna be more, if you wanna contact me directly and not talk to me on socials, you can drop me an email there, or it's bo.lamini.interpret@gmail.com. So guys, thank you. I'll definitely see you on the next video. So thanks you and goodbye.